But in the general rule, I think the source of outperformance comes from an investor's willingness to let something become a bigger part of their portfolio, let them really ride those winners. The ideal would be you get something that sort of takes over and you look at it and it's 20, 25% of your portfolio and it's just kind of gone up 20x and you're delighted, you know.
During this episode, I wanted to particularly talk about Constellation Software, Topicus, and Lumine. But before we get to that, Chris, I just want to start this by just saying congratulations. You shared with your audience that you had your best returns in 2023 since you started your fund. And you managed not to sell any of your holdings during the year. And I think back to our last chat, you had mentioned you only sold one holding in 2022. So making progress on the little you had left to go. And I don't
That's right.
I don't think too many fund managers can say that they had zero turnover throughout a year. So I just really admire your ability to stick with the names you find and give them plenty of room to run. So you can take this in any direction you'd like, but I just wanted to give you an opportunity to share some of your thoughts and reflections from 2023.
Yeah, I mean, 2023, you're having a good year when your worst performer is up 19% for the year. That was Heiko A, but I had a couple that were up about 80%. I'm Technion and Lumine, which we'll talk about later. We're both big winners. I think Copart was up 60%. Constellation, which we're going to talk about, was up about 60%, I think. And these are all, big chunky positions. I run a concentrated fund. So it's just everything really came together, and I've owned all these positions for a while, and it's just it's nice to see that. Other than that, I would say, I didn't sell anything, which was interesting, and I didn't. I had some inflows, so I had some chances to do some things, and I had really two moves during the year that I made, and they were both very impactful. One was adding a lot to Lumine, which again we'll talk about, and then also adding a lot to Technion when I had the chance. So those two worked out well. I mean, the other thing that's always I like to do is you go back and look at the high and low and the differences. And last year it was typical, even though it was a very strong year, that the difference between highs and lows in a lot of names was quite wide, 50% or more. And it wasn't like it was just a straight line up through the year. I mean, I remember in October I had maybe 2 or 3 positions that were negative for the year. I think maybe, I can't remember specifically. I think Lifco might have been one of those that was actually down year to date at one point, and wound up finishing, plus 40 or something. So it's the lesson we get every year, which is there's lots of opportunities, even just within a year, if you're patient with these things. And maybe the last thing I'll say about 2023 was it was another year where the market serves us some humble pie as far as macro forecasting goes. I mean, how much talk we had about there being recession, slowdown, and even if you knew the results ahead of time, I'll take Old Dominion, which is a company I have in the portfolio, LTL trucking company. If you knew what 2023 looked like, if I gave you the financials ahead of time, you would have seen a decline in revenues and a decline in earnings per share for the year. You would for sure not thought that the stock would be up 43%, which is what it was. So, again, just it's difficult to forecast on those kinds of macro variables, and that's why I like to just stick with really good companies that I know well and that are compounding capital high rates, and otherwise sit back and let them do their thing.
It's funny when I look back over the past few years, some of the narratives or best love ideas you have to overcome, as Munger says. And there are two that come to mind that, just starting out as a newer investor and just developing over time and overcoming some of these narratives, there are two that sort of stick out to me. The first is that markets are mostly driven by the Fed. It's sort of a narrative. I've heard some people tell me that, there's no use trying to pick individual companies because the Fed essentially just drives the entire market. And the second one I wanted to mention is that you need to own FANG stocks, I mean, this is essentially developed to be the Magnificent Seven with the addition of, I think, NVIDIA and Tesla. You need to own these stocks in order to do well as an investor, or maybe even outperform the market. And as you mentioned, 2022, the Fed raised rates. Many people were worried about a market crash, market correction, and stocks overall were down. But if you look at a lot of these great businesses, a lot of businesses that you own, you know, the drawdowns, you could argue, weren't really justified if you look at the actual business performance in 2022, 2023.
Mm-hmm.
So investors who were patient saw that opportunity, ended up being rewarded handsomely, like you were in 2023 with your one of your holdings being up over 60%. And it's sort of ironic how, with the benefit of hindsight, what many people saw as bad things happening, all this uncertainty being around, actually ended up being a blessing. And I remember actually one of your old tweets, you posted that you had added to Technion in late 2022, and you shared the multiple, and it was like a 17. And,
Mm-hmm.
from that purchase, you've got 100% appreciation just from the multiple expansion.
Yeah.
So it's quite interesting to think about how, this noise in the markets can really keep people out of it, wait for things to become more clear. So could you talk more about that?
Yes.
Distinguishing that signal and noise.
Mm-hmm. Yeah. I mean, that's important to do. I think, one thing I do is I don't spend time on that macro sort of guesswork. So, I mean, I can't tell you how many times someone has sent me, some kind of think piece about something or other. And, I politely thank them, and then I put that in the delete pile. I don't spend any time on that. I spend more time on my names. I mean, last year I met with several CEOs, and of course, then I spend time looking at new ideas, which is always fun. And so it's really where you put your attention. I really guard that attention carefully. And if you allow yourself to, read into these narratives that people create, then it makes it more difficult to make a good decision, I think. Another thing is just kind of habits. It's taken a long time, but I don't log into my account every day. I try not to look at stock prices during the day. I usually will check in the morning, see what's going on, and then I look again at the close. But even that's probably too much. For most people, I don't think they should probably be looking at it every day. So, I think another key part of distinguishing the noise from the real signals is if you spend time on the businesses that you own and really try to drill down on what the essentials, figure out what really will matter for this business over the next, say, 10 years. And when you make that your filter, what are the critical success points for this thing over the next 10 years? What has to happen? A lot of these other details sort of dissolve. Talks about whether there might be a recession next year. It doesn't become very important because, again, you're thinking way out. You're thinking 10 years, and you're going to own it through a recession or two. And so I spent a lot of time on that, figuring out what are the essential pieces of a business that will help it succeed, and identifying that, and then really staying focused on that.
And again, mentioning the Magnificent Seven and the FANG, it's probably been like over 100 times now. I've seen a chart where it shows the Magnificent Seven performance being way up, and then after you take those companies out of the S&P, it's just like a flat, or it's like a downside. So it kind of gives this illusion to where, there's only a handful of companies that deliver returns in the market, but there's plenty of names out there. But when you put some of these great companies in with all these, poor, just straight up bad companies or poor performers, it sort of hides them.
Mm-hmm. Yeah. I mean, this is another thing why I even hesitate to talk too much about like the market, because people will talk about the market as if it's just sort of one thing. But of course, when you look within it, there's huge variations. Even just looking at the S&P 500, as you mentioned, there's huge variations within it. So you have to be careful about that. And then when you throw in overseas markets, I mean, there's a lot of diversity, a lot of stuff going on.
Mm-hmm. And I'm also reminded, I just recently shared a book review on Willis Johnson's book, Junk to Gold. And I mentioned during that episode that over the last 30 years, there's a chart that was shared that showed the top performers over the past 30 years. Copart came in at number 14. And I think so many
Yeah.
people would be surprised that Copart did better than, companies like Google and Amazon. And it just like, just kind of like
Ah,
it like defies what you would really think about, how like you'd think like the Amazons of the world would be like by far the best performers, but there's these regular everyday type
yes.
companies that, just show up every day, compound, and
Yeah, I love those kind of lists because those are, because you always find lots of names like that. I mean, if you look at the last 20 years or so, Old Dominion shows up there as well, way up there. And you're just like, wow, this little humble trucking company has been that much a performer. I know like Monster Beverage, I think was actually the number one performing stock over the last, maybe it was 20 or 30 years. I forget what the metric was, but again, it's a little bit shocking because you see this mix of business and you're right. You expect it to be dominated by the Amazons and Googles and Microsoft, but there's lots of pretty humble businesses in there that just compound at high rates for a long time.
All right, so let's turn here to Constellation Software. Most in our audience are going to be aware of this company, and if you're listening and you're not quite as aware as what this company does, I did a deep dive on it and a deep dive on Mark Leonard's wonderful letters back on episode 531, so you might go back and reference that. And I have to give a thank you to Chris for putting this company on my radar last year. How about we started off by just talking about how you discovered this company and how long it really took you to coming around to really understanding its long-term potential?
Yep. That's a good question. I'm not sure exactly when. I'm going to guess it was somewhere around maybe, I don't know, somewhere around, say, 2016 or so. And I remember being skeptical of it for a long, long while. It took years. I knew of it, but I didn't bother looking into it because I had such a bias at that time against a super acquisitive company like that. And it was buying software companies. And I think kind of a common area of doubt around it was, well, yes, I remember this was my thought, is they just must be buying a bunch of junky software companies and has no terminal value, and these things are all going to eventually be zeros, and they're just they got to keep running faster and faster to keep it going. And I didn't really spend a lot of time on it for several years. So I would say it was probably around maybe 2019 where I got more serious and I actually sat down and read Mark Leonard's letters, and then I was like, wow, this is worth digging into more. And so. So that's I started to do a lot more work then, and shortly after became shareholder in my fund.
When I released that episode I mentioned last year and purchased my first shares, the share price was around 2,300 Canadian dollars, and at the time I was thinking, hey, I'm paying up for quality. And now here we're sitting today, February 2024. Share price is north of 3,700 Canadian dollars. So over the past year alone, share prices are up nearly 60%. And that's quite high for a company like Constellation, where it's compounding consistently at the 25% range. And I just like to get your thoughts on the recent run up, because it's easy to think, it's just a company that was overpriced is now more overpriced. Maybe there's some developments within Constellation that potentially warrant such an increase over the past year.
Yeah. Well, I would say the big thing is I think the market has come around to the idea that Constellation has found another gear when it comes to deploying capital. So if you look at, 2018, 2019, 2020, those years, they were probably spending $500-600 million in acquisitions, deploying capital. And then it's really kicked up in recent years. It did, $1.5 billion, I think it was, in 2021 and 2022 is similar. And then, the results we have through 3 quarters of last year, they were over $2 billion in capital deployed. So you're already through 3 quarters of a year last year, they're already, 3 or 4 times more what they did in a full year just a few years ago. And so, the market knows that Constellation is deploying capital at, high rates. And so when they deploy that much capital, it's going to be some nice growth in in free cash flow. So I think that's the big one. And I think there was a narrative that started a little bit that, they were butting up against the limits of what they could do. And then, they've just been able to put together some pretty attractive larger deals. I mean, the one last year was with Optimal Blue, where they bought a business for $700 million and they paid $200 million up front, and they get a note for the $500 million that doesn't pay. You don't have to pay any interest in it for 5 years. And it's like, wow, how did you come up with that idea? And that was a business that, they bought it as complicated as part of a transaction. Black Knight is merging with Intercontinental Exchange, and they had to ditch this thing. So it's kind of like a really motivated seller, and Constellation stepped in and bought it. And this was a business that Black Knight had bought for a valuation of like 1.8 billion in 2020, and then they bought another piece of it in 2022 where it was, I think it was like 2.8 billion, let's say, something like that. And here's Constellation swooping in, buying it for 700 million with those kind of deals. So now I think the market's starting to think that, Constellation's got lots of room to deploy capital still, and we'll figure out ways to put it to work. So that's one. And then the other thing, I think that, the other key part of Constellation is the organic growth rate. And I think that's been pretty strong. I think it's maybe even surprised a lot of people. It's been running about 5 or 6% all year. Even better if you look at kind of the core maintenance and recurring. So I think the combination of those things together, you've got, rocket fuel. So yeah, I'm real excited to see what they do next.
So with regards to the Optimal Blue deal, if I'm understanding it correctly, they put down around 200 million. The purchase price is around 700 million. And this seems to be a case where their return on capital isn't going to be, what they typically target, like a 30% range. It sounds like it's going to be a lot higher in this case.
Yeah, it could be. I mean, it seems like it. I don't know. We'll have to, it's still kind of early. So, I mean, the usual rule of thumb is as the deals get bigger, your IRR comes down, which I think is okay in Constellation's case, because like you mentioned, they were doing 30, and now if they do 25 or 20, but can deploy a whole lot more capital doing that, I think that's still creating a tremendous amount of value. So yeah, we'll have to see what, the specifics of the Optimal Blue deal are, but yeah, I'm pretty optimistic that they're going to do pretty well on that. I mean, it's hard to not do well when you only put 200 million down for a business of that size, probably generating, 100 million in profits.
Over the years, I think a lot of people assume that the competitive landscape is going to get quite overwhelming for Constellation. Have you seen that intensify over the years since you've started researching it or first owned it?
Yes, there's certainly been a lot more copycats. And, in practice, as a firm's done some good work on this. And they identified at the time of their report, which I think was last year, something like 34 private VMS consolidators. So it's quite a bit. But one thing that's interesting is that, they are trying to copy Constellation, and they're trying, but when you look at the deals, there is still quite a bit of difference. So, for example, Constellation's average deal, they're buying a company at like 1x sales. These are the smaller deals I'm talking about now. They may buy something, let's say around 3 million in revenue, and their organic growth is like 0, very, very little. But when you look at the private consolidators and the type of deals they're doing, they are larger, 2 to 3 times larger typically. And they have a lot more organic growth. So they're playing a little bit of a different game. A lot of them, they're also, because they're also leveraging up a little more. So I would say, yes, there's more competition, but for kind of the niche that Constellation is in, I don't know that they still have that much competition on those small things. So it's kind of weird. I would say, yes, there's more competition, but there's still interesting nuances, and it seems like there's plenty of room to deploy capital still.
And since they're getting such attractive returns on these deals, I'm sure many of these companies have options in terms of who they want to sell to. What do you think the main motivation is for them wanting to select Constellation? given the attractive purchase price that Constellation's getting?
Yes. So this is something I had to spend some time on to get convinced of, but there is some value in the idea that Constellation is a permanent home for these businesses, that they're not going to, fold it and lay off everyone or kill the business or whatever. I mean, the owners who sell these businesses, if your goal is to sell for the top dollar, then Constellation is not likely going to be your buyer. But if you're more concerned about, you want to have a home for your business there, then that's where Constellation has an advantage. I know that, and a lot of people are going to be skeptical about that, but I've talked to enough people to know that that is part of it. So yeah, I mean, other than that, again, Constellation is still, you are dealing with businesses where there's not a whole lot of competition for some of these, where there's not a lot of organic growth or no organic growth. So Constellation may still be the best option there in those cases.
And many people speak to the decentralization aspect of the Constellation business model. It really helps them scale their acquisitions over time, as many different people are making these acquisitions within the holding company. It gives each business the autonomy to make the decisions they feel is best for them. And it helps keep the corporate bureaucracy that Leonard wrote about in his letters. He mentioned how corporate bureaucracy tends to creep up in businesses as they grow. But I think, as with most things in life, there's no free lunch. What do you believe are some of the drawbacks to decentralization?
Yeah. Well, first, yeah, you're right. I mean, the decentralization has been it's been a key thing. I think it was Larry Cunningham who said that the genius in CSI was that the people coming up with solutions to the problems were the ones who were closest to the problems, which I liked the way that was put. And they do have this culture of sharing knowledge, so it works really well for them. Drawbacks, I would say, well, first, it might be worth pointing out that they're not all decentralized. Like Lumine is not decentralized. They have a centralized M&A team that work together in Toronto with David Nyland. So I have heard that this is not necessarily, I guess you could say it's decentralized because Lumine is making their own decisions rather than Constellation in HQ. I would say the biggest drawback talking to people is it seems to be perhaps around, keeping your team together. There may be some thought that retaining people that are, flung out all over the place is harder than when you're all working together. I've heard that. There might also be, you might lose something by not having a closely knit team that works together versus teams that are spread out all over. But some of that is, by design. I mean, I think Constellation attracts a certain sort of person. And, for example, if you want to get rich very quickly, probably Constellation is not going to be a place you're going to stay very long. Yeah, I mean, it's hard to say because they're so good at it. So, what's the drawbacks for them specifically? I don't know that there's too many, other than perhaps there's something to this that there may be some difficulty in retaining people, but again, part of that is by design, and they seem to have managed through it pretty well.
Yeah, and since I mentioned, decentralization being a key aspect of Constellation as they continue to grow overall, senior managers within Constellation are required to invest anywhere between, I think, 25 to 75% of their bonus into shares of Constellation. So there's a lot of skin in the game within these managers, and a lot of an incentive to act in the best interest of shareholders. But as they grow, each senior manager has less of an impact on the overall performance of the conglomerate. And I could see that making some managers maybe a bit frustrated over time. I'm curious if this is a concern from your perspective.
Yeah, I think it's a concern from like the comp perspective, like it's compensation. If you're suddenly what you do has your compensation is tied more toward the overall, then that could be a problem. But I think that Constellation spends a lot of time thinking about this. Mark Leonard certainly has mentioned it. This is the biggest challenge with them getting so large is how do you incentivize teams and keep it so that what they do, they still have a big impact and can still, do well for themselves. So yeah, that's something to always keep an eye on. And that's kind of where the experiments with the spinoffs are interesting too. There's ways to harness incentives a little differently there. So definitely something to keep an eye on.
It also reminds me, Leonard historically, he's shown that he tries to talk the share price down at times. And I think back, well,
Yeah,
shares of Constellation have gone up 60% over the last year. So how many of these managers want to say, hey, I want to put a significant portion of my income into shares of
right.
Constellation? I'm sure there's other things they might want to do with their compensation.
Yeah, I've heard people say that, when those concerns are voiced, Mark Leonard and the senior execs basically have this line where they tell them that, evens out over the long run. And, it's kind of think more like dollar cost averaging sort of. So, so far, it's worked very, very well because I'm sure there's lots of times, I mean, even in recent years, me owning it in my fund, how many times people have told me it's expensive. So far it's worked out.
In Leonard's 2021 letter, he started to talk about what we can call Constellation 2.0, where Constellation starts to reinvent themselves. In that letter, he talked about how they needed to create new avenues to deploy capital. For those not familiar, their typical deal is around the $5 million purchase price. And just as business scales up, you can only do that for so long. And he mentioned two avenues they could go down to reinvent themselves. The first of which was simply doing these bigger deals, for example, the Blue Optimal deal you mentioned. And then the second way is to start venturing outside of the VMS space and start looking at new verticals, new industries. Maybe you could talk about how this has developed. Leonard wrote that letter in 2021, and it's been a few years since then, and take that whatever direction you'd like.
Yeah. Among Constellation shareholders, this is the talk, like what's Constellation 2.0 look like? And I think we've gotten a preview last year. We've seen them deploy bigger deals and do bigger deals, more complex deals. Will they drift outside of VMS? I mean, I think they've already done it to a degree. I mean, I talk to people, former CSI people, and they already own companies that are not really true, old VMS. They have some, HMS. They have some that are more service oriented. So I think in some ways they have crept a little more into adjacent software. And then I think it was in that last Mark Leonard letter where he wrote about how they looked at a deal, came close to doing a deal that was oil and gas related, and where the motivation was more taxes or something like that. I'm sure it would have been, a really interesting deal. But that was certainly something beyond VMS. So yes, I would say you have to be comfortable with this potential drift to be a shareholder today, because I think that they will eventually do something outside of VMS and maybe a bigger way. And part of that, I mean, you just have to, given their long track record, thoughtful capital allocation, I feel pretty good. It's not going to be something dumb that we're going to wake up and go, gosh, why'd they do that? So yeah, I'm really interested to see what they do. And they may not find anything. It may just be that Constellation 2.0 is what we see today, which is that they still do these little tiny VMS deals, but they're also deploying sizable amounts of capital in things like the Optimal Blue deal and other things like that.
In terms of the runway and continuing to scale up the business, one of the parts that has been or is difficult for me to wrap my mind around is when I hear people say there's a database of 100,000 potential companies that they could acquire. It's like, there's only so many markets, there's only so many niches that can be addressed, but 100,000? So it almost sounds too good to be true. So could you talk about how it's possible the database is that large?
Yeah, I remember when I first heard the 100,000 number, I was surprised too, but then I kept hearing it. from different people who, used to work at CSI. They'd keep putting that number. One person even said it was 200,000. So I don't know, but it's a big number. And when they acquired what was 100 companies in 2022, or so suddenly it puts that all in perspective. There's a lot, and part of it is there are new companies being added to that pool all the time too. So new software companies being created all the time, do all kinds of things, and I agree. I mean, it seems like it's a huge number, but I mean, it's real. I think about, for every different business, there are potentially, who know, how many different potential software packages for that business. When you start to think about it across all kinds of geographies, it's a big number.
So Constellation has spun off two different businesses into public companies, Topicus.com, which we'll refer to as Topicus, and Lumine, both holdings in your fund as well. Topicus was spun off in 2021, and Lumine was spun off in 2023. And since you were an owner of Constellation, you had these shares deposited into your account, which is a quite interesting dynamic. How you have this great performing stock, and it just starts depositing these new companies in your account.
That's right. That reminds me, when we talk about Constellation's gain, sometimes you have to include the spinoffs in there. It's even better.
Right. So maybe you could just talk about why they ventured into doing these spinoffs and how they're value accretive to Constellation shareholders.
Yeah. Well, I mean, I think in Topicus' case, it was an experiment, partly an experiment with incentives like we talked about before. I think it was a natural there because Constellation also didn't own 100% of it anyway. The sellers still owned a large block, so it was kind of a natural. And my understanding is that they were kind of their own little castle over there anyway. So, but I keep hearing people refer to it as an experiment, and to see if what Constellation might learn. There are some differences. Topicus' organic growth rate, for example, is higher, or has traditionally been higher, and so I think that's part of the motivation with Topicus, and with Lumine, maybe it was a little different because that Lumine is more tied to one vertical, media and communications, and that spinoff came off a transaction they did with Wide Orbit, pretty sizable transaction for that group, and it allowed the owners of Wide Orbit to kind of roll over their shares into this thing, and and probably made the purchase price work. I've also heard that it's Lumine was an experiment in a way for David Nyland to kind of run his own thing. He's the CEO of Lumine, and he wanted to do that. So those are some of the reasons I've heard. But there are interesting differences, and it'll be interesting to see how they kind of play out over the next 5-10 years, because Topicus can go across any vertical, but they're more supposed to be confined to Europe. And then Lumine is confined to one vertical, but they could go anywhere. So you have two different wrinkles there in how those play out.
So if Topicus is confined to Europe, does that mean Constellation isn't going shopping in that market?
I think they can still do that. I mean, they have, the way Constellation's database works. So my understanding is that if you have a certain target and you're in contact with that group regularly, it stays. It can't be poached by another group. But if you did lose contact with it, and I think contact means having a meaningful conversation within a year, then it's open for anyone. I think Topicus has advantages in Europe because they're actually there, and there's intricacies about that market. There's obviously different rules and regulations for different European countries. There's different languages, and so I think Topicus has an advantage there. But I don't think that it means Constellation can't do deals in Europe. Same with Lumine. I mean, but when I talked to David Nyland about it, he's pretty confident that he's got a good lock on media and communications, that industry. But I suppose if another CSI group had a media and communications deal that they sourced themselves, then they can do that.
Yeah, and from my understanding, Constellation still owns a portion of Topicus and Lumine. It's not like they completely sold it off. So it seems to me that these spinoffs are sort of a tool for Constellation, in sort of a special situation type deal where it helps them, make a certain type of acquisition, make the deal still work, make everyone happy. And, for example, that CEO wanting his own sort of uh, company to manage. So it seems more so like it's not so much a strategic play where they're trying to arbitrage the public markets
No,
or do something to that extent. It's more so a very, very special situation type.
special situations, yes. And I think in the future, we will see more spinoffs. I mean, when I've talked to people there, yes, and it's unequivocal, there will be more spinoffs. It's just kind of, what it will look like. But I think it will look more like Lumine. It will be those kinds of spinoffs. It'll be part of a larger deal, and and that will be the natural time to spin off something by itself. That's what I suspect. I don't think, and I think Jamal, the CFO at Constellation, may have said this at some point, that they're not likely to just take like, Harris and spin it off as its own, one of this operating groups, and just spin it off on its own. It's more likely to be a specific vertical. And my guess is that it will be a specific vertical in conjunction with some kind of larger transaction like with Lumine. That's my guess.
How do you get started with stock investing? I've put together a course to teach you everything I wish I knew when I first started investing in stocks. Let's start at the beginning and ask, what is a stock? Let's zoom on into what it's actually like to buy a stock. A few options are Charles Schwab, TD Ameritrade, Ally, E-Trade. Fortunately, you won't have to necessarily calculate all of these taxes yourself. I'll outline a few main ones to be aware of throughout your lifetime investing journey. As Warren Buffett says, your best investment is yourself. There's nothing that compares to it. By the end, you'll be savvier about stock investing and personal finance than the vast majority of people. Even if you're not a total beginner, I'm confident you'll get a lot out of the principles and strategies I outline, which we'll build on throughout. A link to the course is available in the description below. See you there.
One aspect I particularly find interesting with these spinoffs is that it can actually lead to pretty good investment opportunities from the aspect that institutions that own Constellation, they get these other shares deposited. And just because of their mandates, they can't hold Lumine or they can't hold Topicus. So they don't even care about the price. They're just selling it. And it can lead to the situation where you have four sellers. It overwhelms the market with sell pressure and gives long-term investors a pretty good opportunity in terms of the entry point too. I think shares of Topicus fell by over 50% from their high. I'm not sure if that was sort of a dynamic playing on at that time. And Lumine also.
No, I think with Constellation it's maybe a little different because Constellation shareholders. I think it's a little different. Like with Topicus, I don't think you saw a lot of that dumping early, and you can see it in like the volume. I remember doing this. I saw the numbers might be wrong, but I did this at the time. When you looked at like the first 10 days of trading at Topicus, maybe it was like 15% of the shares traded. Of those shares turned over. So a lot of Constellation shareholders kept it. And because Topicus was pretty sizable even out of the gate. But Lumine, it was different. Lumine, it was like more than 50% of the shares traded hands in those first 10 days because it was a lot smaller. And so I think even some of the large, Constellation shareholders were just dumping it because it was too tiny, it's too small. So I think that plays into it. You have a little bit of different dynamic that way, which makes it interesting. And with Topicus, that was in 2021. I think it spun off in February. And if you remember 2021, I mean,
euphoria.
Software and tech and stuff it was a very kind of a little bit frothy. And so I think that stock got kind of caught up in that wave. I held it the whole time through. So I rode it all the way up. I remember at one point, and maybe I was up 140 some percent, and then I rode it all the way back. And eventually, I think it did touch my cost basis very briefly. So it's been a wild ride. But if you look at the overall, CAGR return that I had since I bought it, it's been good. It's been decent. I've used those times to acquire more. I think the journey for those has been a little different, but the spinoff dynamic, I think, would definitely happen more with Lumine because that started trading. Again, if memory serves, it was like 17 out of the gate. And over the next several weeks, it fell to like 14. Just think about that. And then it finished a year at over 30. So quite an opportunity that was.
Yeah. So you had these shares of Topicus deposited on the spinoff. And of course, you could have decided to sell those shares, purchase another name in your portfolio, go back and purchase more shares of Constellation. So what was it about Topicus you think that, warranted it deserving a spot in your portfolio?
Yeah. I mean, I'm intrigued by the whole thing. I mean, in some ways, we talk about Constellation 2.0. I mean, Topicus is the next kind of little constellation. I mean, it's Constellation, but in Europe. And a friend of mine pointed out to me by email that Topicus today is the same size as Constellation was in 2013. So if you roll back then, you'd probably be pretty delighted if you could go back and invest in Constellation in 2013. And I think you have that chance now. I mean, they have a very big fragmented big market in Europe, I think, to deploy capital. And it's just that basic underlying algo there is attractive. I mean, you're buying a company that I think should be able to grow at least 25% a year, and they're reinvesting everything, 25% return on invested capital, and they're reinvesting everything. And, you throw in some organic growth and you've got a company that, could compound free cash flow per share 30% a year for years. So that's the basic attraction. And you're doing that in a business without leverage, without, it's not cyclical. It's very sturdy, generates a lot of underlying cash. You've got great incentives. Same incentive structure at Constellation carries over to Topicus. You don't have to worry about dilution. Another great thing about Constellation, the share count stays the same. You don't have to worry about necessarily them doing something really dumb with a lot of leverage. So there are ways these companies get in trouble. I think you're pretty safe there with Topicus. So that's the appeal. And it's a little smaller. So like we said, the runway in theory should be greater.
And in doing my research on Topicus, it seems that the private equity market in Europe is less developed, which potentially leads to less competition for the likes of Topicus in terms of these acquisitions. And then another piece I thought interesting was that Europe seems to be a pretty fragmented market where you have, one niche in France, the same niche in Italy, and you have two different companies operating within that. So it's difficult for companies to cross borders, I should say, or maybe more difficult than, say, the United States, for example. Is there anything that you maybe don't like as much with Topicus relative to the other two?
Well, I mean, if I had a complaint about Topicus, it would be I wish they could be a little more accessible, let's say. I'd love to see Robin, the CEO, write an annual letter to shareholders, kind of giving us the lay of the land from his point of view. In general, I think sometimes the complexity of Topicus keeps shareholders away. There's kind of a little bit of a bar you got to get over. If you're not familiar already with Constellation, there's kind of this kind of bar you got to get. It's almost like Mark has designed it so that there's this hurdle you got to get over to be a shareholder. It's not so easy. And I guess it kind of works because it attracts a certain kind of shareholder, right? You're not going to get someone who's just looking to make a quick trade because you have to put so much work in understanding it. Because there's some accounting things that have been bizarre, the way the deals have been structured, and like I say, you don't get a quarterly earnings call. Management's not doing road shows. They don't have a nice little presentation. All these things that investors love to digest. You get a very simple, public disclosures, and then Robin participates in the annual meeting that Constellation has, and sometimes there are questions put his way, but you don't get a lot, and management doesn't really talk to investors. So these are kind of the hurdles and things that if I, could change a little bit about Topicus, I would go in that direction. I don't think they have to go so far as to hold quarterly calls or do that, but I would like to see maybe Topicus hold their own annual meeting or like I said, an annual letter from the shareholder CEO to shareholders. So if I had to say what I didn't like about it, it would be along those lines.
What's also quite interesting about Topicus is the organic growth rates being higher of the companies they're purchasing. Is this a strategic play in terms of the European market, or why do you think they're approaching it a bit differently of looking for higher organic growth?
Yeah, I mean, this is part of the original appeal of Topicus, is that they had this higher organic growth, and it is higher. I mean, it's probably run like 6 to 8%. And I would say like the maintenance recurring, the key piece is probably 8 to 9, and I think in third quarter hit 11. So I mean, the model works better. It's easier when you have that organic growth, right? It's just kind of the math. It makes it easier to compound when you already start with your base assets are going 10% a year or whatever. So that's always been part of the appeal. And why that is, I think Mark Leonard's talked about that. It's one of the things they want to learn more from Topicus, how they achieve that organic growth. I think it comes down to being focused on it. We've talked already a lot about incentives on this interview, but from my understanding is Constellation's incentives, you get paid for, deploying capital, making deals. And at least traditionally, you haven't been so much paid to create organic growth, because create organic growth requires attention and expense. And and when you look at it, it's maybe not the best focus for that management team. But Topicus has figured out a way to do it. So it'll be interesting to see if they can keep that up, and if some of that knowledge base transfers over to Constellation. I think maybe some of it has. I would be curious to hear what Mark says on that, because the Constellation's organic growth, as we've talked about earlier, has I think been pretty strong, stronger than most people would probably have guessed. 5% plus in the last few quarters of last year.
Let's turn to Lumine now. This one's also different, just like Topicus is a little bit different. This was the 2023 spinoff. It was merged with Wide Orbit. So Lumine seems to be doing fewer volumes of acquisitions, and they're doing larger deals. And they don't have a wide range of verticals they can go into. They just have one vertical they're getting into, which is the media and communications. So Lumine is another one that, you got the shares and presumably added to them. So I'd like for you to talk about this one as well.
Yeah, I mean, when I first looked at Lumine, I remember talking to, David Nyland, the CEO, and he, kind of trying to suss out what the differences would be, how Lumine would be different maybe than Constellation. And one of the things that appealed to me about it was this idea that Lumine would have a heavier weight or tilt towards carve-outs. Now, I know that's not the technical definition of a carve-out, what they're doing, but that's kind of the language they use, is when they buy a subsidiary, kind of an orphan from a much larger company, like they did with Nokia. And that was the deal that really put rocket fuel in the share price at the end of the year there, last year. So I like that. And I like that because there's a lot less competition to do that. There's a lot more technical skills and things involved in doing those kinds of deals. So there's not as much competition. And so I thought that would also lead to high returns. And David and his team have done this. So they know what to do. So actually the way it's played out is kind of the way I thought it might, which is you wouldn't see deals for a little while, and then all of a sudden they would do something kind of sizable and interesting. And I think that's kind of what we should expect from Lumine. So it's really interesting because it's Constellation. It has the same incentives, and the reporting is the same, so it's very similar. It feels familiar, but then they have this different tilt or bent. They have the specific vertical, larger deals, carve outs. I think that's very attractive, and they have a lot of room. One of the things I've heard sometimes when I would talk to people about Lumine earlier is they're like, yeah, well, it seems like it's confined to one vertical and not as attractive, but it's an enormous vertical. And when you talk to them, David, about what kind of pipeline they have, I mean, we're talking about low thousands is their pipeline, and they're in touch with companies in the low hundreds. So again, Lumine owns less than 30 businesses today. So a lot of room, a lot of space to grow. And so I thought it was a really appealing setup and worth having its own real estate in the portfolio.
With that spinoff in the acquisition of Wide Orbit, they paid $497 million. And from what I've researched or picked up, it seems like they paid around 11 to 12 times EBIT, which doesn't seem like Constellation to pay that sort of multiple, but it does have a strong organic growth rate. In 2021, its organic growth was 10%. Have you thought about whether they've taken a lower hurdle rate in this deal, or what have you found on this front?
Yeah, it's the deal. It's higher than what you would see typically for a CSI deal, but Wide Orbit is a very good business. They've got tremendous pricing power. I mean, it's a business that's involved with advertising for radios and TV stations, and it's not something you can rip out. I mean, it's really mission critical and functional to those businesses. So I suspect that, because I know just culturally within CSI how they cling to those hurdle rates. I don't think that they lowered their hurdle rate on this deal. I suspect that they will get there, or they must see a path to get there. And my suspicion is that it's in that pricing power and the stickiness of that business. So, we'll have to see, but I think it looks like a very good deal.
And I could see one potential advantage for Lumine is the potential synergies within the subsidiaries. I had found some notes that one company that sold to Lumine did so they could learn operational best practices, meet industry peers, and look at natural synergies and complementary product offerings. So this seems to not be as big of a priority for the Constellation Software or Topicus, but maybe more so an opportunity for Lumine.
Yeah, could be. I mean, I also think that, you look at media and communications, and there's a lot of these older media and communications that are not really growing. And so in that sense, it's a very target-rich environment for a CSI type mentality to come in and redeploy those cash flows. So I think that's part of the appeal there as well. But yeah, I think, the other interesting thing is about Lumine is that David Nunn and his team, they have sourced all their own deals, at least, up to the time when I talked to them. Maybe the last couple of deals, maybe this isn't true, but so I think there's quite a bit of talent in that team, also, that I think plays into it.
And Lumine is generally doing deals that are a bit larger. Do you expect the return on capital to be similar for them?
Yeah, this is another thing where, again, like we talked about before, the larger deals in theory are going to have lower IRRs. So, but, Lumine are doing these sort of quirky one-off deals. So it may surprise us. We'll have to wait and see. But I suspect with Lumine, you're still going to get, 25% type returns on capital in that business. Maybe even better with some of these.
And one aspect that is probably pretty intriguing is sort of the copy and paste format. For example, the incentive structure carrying over from Constellation to Topicus to Lumine. Have you seen that incentive structure overall carry over one-to-one essentially?
Yep, it's the same. And, that's part of the big appeal too. So they're not handing out stock options, and comp is the same. So it's something like, 75% of the CEO's bonus is used to purchase shares, and then those shares are locked up for 3 to 5 years. So I've always really liked that about Constellation. When I think about, incentive structure in my portfolio companies, Constellation is the number one, the gold standard, and then the spinoffs are the same. So yeah, that's a big part of the appeal. that's exactly the kind of things they focus on, are the kind of things we focus on as investors, which is, returns on capital and growth. And that's what we want.
I also wanted to talk about the valuations. I had spoke with a member of our investment community that manages a fund, and he was sharing some of the information he had on these companies, and he owned all three. And he was kind enough to share with me the analyst expectations that he had for these companies for 2024. Take analyst expectations with a grain of salt, but it just sort of points to what people are expecting. So this is from mid-January, so prices change day to day. But just to give you a general direction, he shared a multiple of 36 on 2024 earnings for Constellation, a multiple of 32 for Topicus, and then 32 for Lumine as well. So the market seems to be putting a bit of a premium on Constellation. They're probably much more well-known, and a lot more investors probably know about them. And it seems a little bit counterintuitive given Constellation's size that they would be trading at a higher multiple. So maybe you could just share your thoughts on their current valuations in light of everything we've talked about, in light of the quality, the management teams, and such.
Well, taking those numbers at face value, is 36 and 32. To me, that's kind of in the realm of the rounding error. So I don't know that would be that much different. I also think that if you're a long-term investor in these, then, the exact multiple maybe will fade in importance a little bit. And the way I think about it is I always think about things kind of like 10-year commitments. You look out, and, the basic math of it is if it's 25%, let's just say if it's 25% CAGR over 10 years, that's 9x. Think about that, 9x. So suddenly, and it doesn't have to be that number. Make it, if it's 20%, I think it's 6 something. So suddenly, whether it's trading for 25 or 30 or 35, kind of doesn't take on as much. If you knew it was going to be 9 times higher, or let's say earnings were going to be 9 times higher 10 years from now, then I think you're not so much worried about whether you're paying 32 or 35 or 29 or. So that's the frame of reference. Obviously, you can't pay 50. You can't pay crazy multiples, but you have more room than you think with some of these. And then even so, if you wait, you almost always get chances. We talked about it. Lumine briefly hit, got down to 17 handle in, I think it was October, and it finished the year over 30. So that's dramatic. You might not get quite that swing, but for all these companies, you're going to get some chances. So there's 2 different ways. I always say, like, if you love a company, you've done all the work, and for me, the hurdle rates are high for me to find something. So if I find something, I'll start small, even if it's trading at 31 or 32, 35, and then you can always build it up, but later. But the problem is, if you wait too much, sometimes it might go a year or 2 before you really get a shot, and then you would have been better off just buying it when you first wanted to buy it. So I don't get too, I don't put too fine of a point on, what the multiple is to that extent. The way I think about it is just a very simple model of, they have so much capital today, they're earning a return on that capital. You forecast that out, how much are they going to reinvest of what they make, and you kind of, you get a number 10 years out, put a multiple on that. What's your IR? So you've got quite a bit of room to play around with those variables and adjust them along the way. But I think these are pretty attractive to own over a 10-year period of time.
I love that you just kind of showcase the example of 25% over 10 years is a 9x in the earnings potential. And I was actually on a call with our community yesterday talking about this idea of paying up for quality. And I wanted to tie in the numbers and share just something very similar to what you did. And, I don't think enough people probably do this because they probably think 25% consistently isn't likely, or it's going to be just extremely difficult to do. So what I did is I spanned it out over 5 years, and I said, what multiple could you pay today to get a 10% return? And then, say you sell at a multiple of 25. Well, many people might be surprised that you could pay a multiple of 54 and get a 10% return
Yeah.
over that period. And then, and there's a few assumptions there that are baked in. So one, a Constellation has had return on capital over 25% over its tenure today. So that's, if you would have modeled out Constellation 5 years ago, you would be underestimating its growth. And then you're also underestimating the terminal multiple. So you're getting much higher returns in that example. And to your point, looking out over 10 years, that just lengthens, your returns and, increases your returns over time if you have that longer time horizon as well.
Yeah. I mean, this is a great secret of long-term investing in high quality businesses, is that the compounding is amazing. I mean, when you work it out in a spreadsheet, you can do 20%, 25%, whatever you want over 5 and 10 years and see what those numbers are. And then you can kind of, I love what you did, backing the multiple. I do that too all the time. I've done that. I remember I did that for my investors in Copart. My investors in my fund, I used Copart, and I think it was 2022 because I went back to 2012. And I said, what multiple could you have paid back in 2012 and earned at least, I don't remember if it was 10 or 15% return that I used. And the multiple was really high. It was like 60 some times you could have paid and still gotten, 15% return on your money. That's what it was. And at the time it was trading for 25. So Terry Smith does this too. His letters, he'll look back at some of these great compounders and say, what you could have paid, what the multiple could have been, and you've still gotten a market return. And it's always a surprisingly high number. Now you have to be a little careful with that, right? You can't just willy-nilly start paying big multiples and thinking that you're going to get bailed out. But there are some companies that, you do the work on it and you get conviction that they can repeat their formula over 5 and 10 year periods of time, then it should work out. And you collect enough of those, right? It's not like you have to make one bet. You can create a portfolio. You get 10 of these kinds of businesses. And that's the other thing. When you do it on a portfolio basis, you're doing 10 of them. How many do you really need to work out just like you think? I mean, it's, you get a couple, you're going to be very happy, especially if you let them just run and you don't cut back and trim your winners all the time, which is what another thing people tend to do, to sabotage their returns.
Yeah. And I think it's also important not to chase things, chase something that's gone up in price, say, hey, I'm paying up for quality. It's a long-term compounder because, you mentioned 2023, a lot of these companies are very choppy. Technion, when I check its share price, it's either
40, 50% differences between the high, it's a lot, and just within 1 year. So, and these are among the highest quality companies around. So yeah, you're going to get chances.
I'm curious, if you were given fresh capital today, how would you think about allocating it? You don't have to say Constellation, Topicus, like, you have 11 holdings. So how would you generally think about putting it to work?
Well, I think about position sizing. So sometimes, I don't mind using Constellation here. I probably wouldn't add to it if I got fresh capital, only because it's my number one position now, and I think it's probably 12 or 13%. So, whereas certain other positions are a lower percentage and perhaps, just as attractive. So some of it is, position sizing kind of guides where that fresh capital goes, but then also looking out on that sort of 10-year model that we looked at, where's the most attractive place to put it. And there's always, a couple that stand out as obvious places that I would put it that are well below kind of my thresholds on position sizing, because there's some that there's some guardrails that I put in place for myself. I don't like to necessarily push anything above 10% with capital. I'm perfectly happy letting it compound. And if, gets to a bigger number, great. I'm totally willing to do that. But as I get inflows, I don't like to push things above 10. So my positions tend to be kind of right now, because the fund's still relatively young. It's only 5 years. The span between kind of these positions are like, 8 to 12, kind of in that range. It's not like I have 15%, 20% position, and then I have 4 or 5, 3% positions. I don't have that. So to answer your question, I mean, that's the way I would think about it. First, just kind of looking at the position sizing and then kind of gauging attractiveness from there. And then, it doesn't, if I don't, it doesn't bother me to hold cash for a while. If I, sit on cash for 5 or 6 months while I think about it, it's okay.
When I look at the stock chart for Constellation, I can't help but draw parallels to something like Microsoft in 1999. I think Microsoft is like a 60 PE or something. I mentioned forward multiple for Constellation of 36. Is there ever a point where you'd trim it back if it became too big of a position in the portfolio, or the valuation felt a little bit uncomfortable?
Well, as a general rule, I don't trim. So it would have to be like really egregious. So that's number one. And even then, I mean, Topicus, you could argue, got pretty egregious in 2021. I never sold it. But that's also because I didn't necessarily have anything else that I was pounding on my, anything else that I was really wanting to buy. So, sometimes it's dictated by what other opportunities there are. If I had something today that was like screaming by that I have to own, I have to give some hard thought to whether I wanted to trim something else or where I would get the capital, because right now I'm fully invested, and I've been fully invested for a while. I mean, cash is less than 1%. So it's not like I have room to do anything right now, other than sell something first. So all these considerations come into play. But in the general rule, I think the source of outperformance comes from an investor's willingness to let something become a bigger part of their portfolio, to really ride those winners. And if you do get something that, the ideal would be you get something that sort of takes over, and you look at it and it's 20, 25% of your portfolio, and it's just kind of gone up 20x, and you're delighted, So that's kind of how I think about it.
It's funny. There's a few people I don't know personally, just see them on Twitter post their portfolios, and Constellation's become an outsized portion because they've never sold a share.
Right.
I also wanted to mention that you had a great conversation with my co-host Kyle Grieve on our Millennial Investing Show. You talked all about serial acquirers, and that's sort of a bigger theme in your portfolio. We didn't talk really too much about Technion or Lifco or Heiko, and those are also in your portfolio. So if people would like to learn more about the serial acquirer model, I would point them to that episode that I'll be sure to link in the show notes. And for those in our audience, Chris, who would like to learn more about serial acquirers, other than referencing that episode, is there any other resources you would point to?
My friends at In Practice have done a lot of good work on the serial acquirers. That's a paid subscription, but they have a lot of stuff on all the names we've talked about, serial acquirers. So that would be one. Definitely recommend that. There's a free site called acquirers.com. You can check that out. I think there's a free book there that gives kind of a overview of the serial acquirer model. So I'd recommend that. My friend over at Oddbjorn over at REQ Capital, they've just released within the last, couple months, a huge mammoth 300-page slide deck on serial acquirers. I'd definitely recommend that. So yeah, those should definitely, it's enough to chew on for anybody there. I would say those things, start there.
Wonderful. Well, Chris, always enjoy having you on the show. Feels like such a privilege to have an opportunity to chat with you and sort of pick your brain on some of these things. I want to give you a final handoff for those in the audience who want to learn more about you and what you're up to do. Please point them to any resources you'd like.
Sure. Well, thank you, Clay. It's always good to be on. You always agree because we have good conversations. You ask good questions, so I enjoy it as well. If people want to find me, Woodlock House Family Capital is named my firm, and there's I write a very occasional blog, and I haven't really written it in a while, I know. But there's a lot of stuff on there to read from the past, and I'm still active on, we used to be Twitter and now X. not as much, but I still will post things occasionally there. So those are two ways to keep up with what I'm doing.
Great. Well, thanks a lot, Chris. And I'm excited to watch the Constellation story play out over the next 10 years.
Me too.
See how it ends up.
Yep. Great. Thank you.
Mark Leonard is a very interesting character. He's a billionaire, yet nobody really knows too much about him other than what he's put out in his shareholder letters. There's probably 2 or 3 photos of him that exist on the internet, and not a single interview is publicly available with him.